Inflation data was in, we were expecting 2.9%, we got 3.1%. When that happened, the investment world collectively lost their mind. Now, there is a problem with inflation getting sticky around 3%, which we will get to, but it's not the reason most people are freaking out about this. So this is the article that the Wall Street Journal ran for me yesterday, which was February 13th. Hotter than expected inflation clouds, rate cut outlook. Here are the graphs if you're not familiar with what's been going on lately. So inflation has come way, way down since the kind of post-pandemic spike, and it has kind of leveled out here. This is overall. Core has continued to come down, but has definitely started to level out as well. This, of course, strips out gas and food prices, which tend to be a little more volatile. So this is the problem is that inflation is not headed down to the 2% target that the Fed has, and that's what they're trying to see before they start to cut interest rates, which they've kind of promised would be this year, but is starting to look like it's at least going to be delayed this year, if it happens at all this year. So what is the concern here, right? Is the concern that inflation is still too high? Well, I would argue that 3% inflation, although it is certainly higher than it has been for the last 10 to 15 years, is nothing crazy, right? Here's the CPI. Now, this only goes to 2022, so don't pay attention to the end of this because it's come way back down since this. But I'll put a 3% line in here, and you see that 3% is really not abnormal. We've gotten used to lower, but 3% is certainly not inflation that anyone would be freaking out about. Okay, so is it interest rates, right? Are interest rates so crazy high that they're really going to be a drag on the economy? Well, here's the 10-year Treasury. We're about 4.1 right now. You can see that through the vast majority of our history, interest rates have been above 4.1. We have certainly gotten used to lower interest rates than that. In fact, the 10-year Treasury has been as low as below 1%. And we typically have seen it over the last 10 to 15 years in the 1.8 to 2%. But to be perfectly honest, there's not a lot of good economic data that says that like 4% interest rates are going to create a real drag on the economy. We certainly saw interest rates like that through the 80s, 90s, 2000s. And GDP growth, gross domestic product, kind of measures the size of the economy, has not changed dramatically over that time. So this thought that like we're really creating a drag on the economy with high interest rates, I just don't buy it. So we're not worried about inflation. We're not worried about these interest rates because 4.1 is just plain not that high anymore. What are we worried about? Well, really, the big concern, the freak out is over the stock market, right? But we have to learn to understand that the stock market is not the economy. Most people associate their 401k balance with how the economy is doing. Nothing could be further than the truth. If we try and do take actions to boost the stock market, it is digging yourself into a hole you want to be in. You need to make strong decisions about what the economy needs. The stock market will eventually sort itself out after all the crazy swings and whatnot around speculation, optimism, all of these things. So, 3% inflation is not that bad. 4% interest rates is really not that crazy. And the reason inflation is becoming sticky is because the economy through all of this has done so surprisingly well. It has not dropped the way we thought it would. The economy has kind of not fallen apart in the way we thought it was when we so aggressively raised interest rates. So the economy is doing fine. Are we really worried about the economy doing poorly through this? It's shockingly, this is a situation where the problem we're worried about is the solution to the problem. If the economy started going through a downturn, inflation would slow down quite a bit, and the Fed would likely drastically lower interest rates to fight some type of a recession. And then kind of the whole problem that we were worried about goes away because lowering interest rates would probably have a pretty dramatic impact on the stock market. Now, we might go through a little downturn based on a little recession or something along those lines. But these concerns is really just around, oh boy, the stock market's dropping. It really is not connected to how the economy is doing. So what is the problem, right? This is kind of the whole point of the video. The problem that no one's talking about is that if we continue to keep interest rates where they are, it's what we pay on the debt. And that's a problem. Now, I am not one prone to freak out about the national debt. I will share a video at the end where I kind of explain what's going on with the national debt. And in that video, I tell you, you need to look at the debt this way, which is the interest cost of the debt divided by GDP, which effectively just inflation adjusts it and adjusts it to the size of our economy. And you'll see very recently that the cost of our debt is spiking dramatically. even though it looks like it stayed relatively same for the last 10 to 15 years. So how did we, this is the same time period right here of 2005 2020, dramatically raise the size of the debt without dramatically changing the cost of the debt? That's because during this time, interest rates were near zero, like certainly under 2%. And when the cost of the debt is near zero, you can get an awful lot of it without moving the needle in terms of what the cost is. However, when we started raising interest rates to combat inflation, all the debt that's rolling over, meaning old debt that's coming mature, and we're having to put it into new debt instruments, new bonds, we're having to pay a lot more interest on it. And certainly any new debt, we have to pay on the current interest rate, right? Like a bond we sold 5 years ago, we're still paying substantially lower interest rates on that debt. But as it rolls over, the longer we keep interest rates high, the more and more of our old debt we have to pay this new interest rate on. And the government, I know no one likes the government or politicians, but they do their best. But over the last 10 to 15 years, they've worked themselves into a situation in which they've built up so much debt that they have to exist in a low interest rate environment. The Fed wants to get back down to 2%, not just to help the American consumer, but it's because that's the interest rate that they pay on their own debt. That's why it's so important to get interest rates not down. That's why inflation getting sticky, stopping the Fed from lowering interest rates is going to have a dramatic impact on the American budget, right? The federal budget in revenue and things. So if you want to understand more about the debt, this video will go all through it for you. Otherwise, I hope this has been informative, and I will talk to you soon.